Hello, everyone. Welcome to today's session. Let's get underway here. Starting off with current market conditions and our overall top-down approach here. Looking at the long-term market trend and signals, we know we're sitting right at the upper end of this bullish trend and working on a breakout on S&P 500. We'll zoom into this a little bit, but we're up in this stratospheric range right now in terms of the rank of this bull market, 22.57, and that's about as high as it gets in terms of this indicator. We've talked about that. We know where we're at. We know we're in this the upper end of this range, and it's just a matter of how is that going to consolidate / reverse first. Is it going to move a little bit higher first and then find some support, consolidate, or are we going to start to retrace back down from here? In the shorter term, though, we're moving back to the bullish side and continuing this overall run on S&P 500. Breadth really didn't give a lot of confirmation on this last update as of yesterday, and a sentiment towards the upper end of that range. So really not a lot of fear taking place. Trend and momentum is still working to the upside. And so we still have an overall longer term bullish tone. Shorter term, we do have the breadth is really the only issue is the 0.63. We have more bears than we have bulls on currently in the database, and that's not surprising. It's been happening like that really for the last year. We've kind of seen a little bit lighter buy-sell ratio, and that's okay. That is what it is, but it can be an indication of a little bit tired, slowing market when we don't have a lot of the market participants included. We are seeing buy-sell ratio on NASDAQ 100 pop back up above 1. Utilities back up above 3. Everything else, not too far. Industrials are 0.78, 0.76 on S&P 500, so still less than 1. And that we'll see how that ends up playing out today. S&P 500 pattern, we had that good solid bar yesterday, and the areas that we had talked about. Let's see where we were here Tuesday. So this was Wednesday, this was Tuesday back here. So we really hadn't had that move quite yet, although I'm sure we were talking about support ranges right here that had been holding up some of those bottoming tail bars. Now at least on SPY, the difference, the chart pattern on SPY and SPX are a little bit different, and same with the futures as well. But for the most part, they have very similar patterns. And in this case, we do have a breakout on SPY. As of yesterday, it's closing. Today, relatively light day, kind of an indecision day. We'll see if we get any acceleration before the close. What are we at? 12 o'clock for me. So we're 2 o'clock Eastern, and so a couple more hours of market activity going on. Let's look the other two issues that are noteworthy. Number one, the bond market right here. We're seeing both SHY and TLT moving back to the upside, and so finding some strength. We talked about this initial move. It started to retrace and collapse, and it really found a lot of support right here. So really bullish type price pattern in bonds. There is a double-edged sword to this move in bonds, and we'll talk about that as well. But let's look at SHY. So let's talk about this still, because the bond market, inflation, and the Federal Reserve are still the major talking points right here as far as equities, because we need, at some point we're going to see the raising of these interest rates slow the economy to the point that we get a recession. Well, the last two manufacturing numbers, I can't remember the exact acronyms of those, were declining. So the manufacturing number is starting to decline. So we're starting to see some indications of economic slowing in certain places as well. That could be why the bond market is rallying, because it knows that lower interest rates are coming because of some economic conditions that are starting to weaken. So whether or not that's the case or not, it's always hard to put your finger on exactly what's happening, but we know the general thesis. We know that interest rates have been high because inflation has been high, and we know that high interest rates ultimately slow the economy, and that's the issue now. Is, are we starting to see that? We really hadn't seen it much and we're not seeing it a lot, but there are some indications of that happening. So in terms of the bond market, that's the double-edged sword. It's what the Fed wants, but as it's happening, it's not what the stock market is going to want, because it is going to ultimately hurt economic growth. But stock market typically is looking out past 6-8 months. So it may already have anticipated the fact that we're going to have some slowing and priced that in months ago, and then moving higher from here. That's the interesting part of the stock market, is it's always a future-looking beast. It's always looking forward, and anticipating what is coming. And pricing that in, making decisions. I'm buying today because I think this is going to be here, or I'm selling today because I think it's going to be here in the future. It's a real-time projection, essentially, of everyone's anticipation of the future. We're buying or selling in real time right now, as of today, based on where we think it's going to be at some point. Okay, that's the vast majority of market participants. So as we're watching it, there's all of those different rationale. Everybody's reasoning for buying or selling is different, but if it's a group consensus and the market is the group making the consensus, then that's what we're most interested in as that unfolds. So S&P 500, SPY primarily is what we're looking at most of the time as the market. The market is a lot bigger, and SPY is sometimes weighted a little bit oddly, to where there are a handful of stocks that are moving that more aggressively, but that is why we also have different things like the buy-sell ratio, which is of thousands of stocks. Okay, so we get a little bit different market perspective that way. We also have one of the other things we were talking about in terms of bullishness or incentive for the market to go higher, is we do have oil prices. I haven't looked at them as of this morning, but let's see what they're doing now. They have been falling, a little bit of a rally here. So we saw that break through this resistance, or this support area, retraced pretty heavily, now starting to bounce back up. We'll see what it does if this overall downtrend continues to be in place. But weakening oil and lowering interest rates as bonds go higher and equities go higher, those are things that equities are going to welcome, are lower oil and lower interest rates as well. We'll see. It's a nice move today on oil. So that's just an oversold bounce, or if we're getting still in that corrective zone, it's still in that counter trend move where the 6-month time frame is connecting to this low point and this high point. And so our Fibonacci levels are working this direction. So at the 50% level is right here, meaning of this trend from this low to this high, we've retraced or moved back 50%. That 618 typically is kind of the last line in the sand. Once it breaks through that, there's a high probability that that trend is now reversed. Okay, it can go all the way back to here though, or at least it's going to retest that or make a double bottom attempt. So when it's holding up inside of this box, inside of this 382, 618 box, okay, we can get support at the 50%, we can get support at the 382, we can get support at the or I said 50% and the 618. Anywhere inside that zone, there may be ranges for support, and you can see 2 levels or approximate levels on that 50%, pretty close. It failed and broke through that. Now holding 618, and let's see if it retests this area as well. That's oil. Let's look at the sectors we were there. Didn't see a big change. We are seeing a few things starting to move back up. Healthcare, seeing some biotech names and medical stocks also in that new buy list, as there almost always has been so far this year, and seeing energy still weak. Everything else kind of stuck right there in the middle with some holds. We're seeing a few little trickles here. You're seeing some uptrends happening. These are today during the day, so we're seeing a few things maybe shifting. And if we get some support and some acceleration on this breakout, it could pull the rest of that market back in again. We'll see how that starts to look. Those are really kind of the big picture perspectives to be focusing on. The biggest picture perspective that we know is a very slow moving train, and that is this one, bond yield curve. Hey, remember that this is the process. This is what is going to be correcting itself needs to start to correct itself over the next few months and years, and it can take years. We can have elevated interest rates, we could have all kinds of crazy things happening, but in most healthy economic conditions, we don't have short-term yields higher than long-term yields. That at some point will correct itself, and typically it'll come along with a move lower in economic growth, and a lot of times stock market as well. Just be aware of that in terms of where we're at in the trend. We're having some nice, acceleration and momentum, but we are towards the upper end of that range. Now let's talk a little bit more about following up on Tuesday. One of the things we talked about an entry process. Let's see if we can find something out of the new buy and go over really any of those. Oh goodness, GME, there it is, 27%. Let's see what I wanted to focus on. Actually, let's go here because we were talking about selling. We were talking about taking gains at a specific target. So let's pull up an example here and say, let's look at USAP. We'll follow up on this because we talked about it a little bit last week as well. The 1 year time frame. So in this case, there are two ways to sell. There's lots of ways to sell, and none of them are wrong as long as they're within your trading plan, right? And they all come with pros and cons. Okay, one of the things we don't know when we're dealing with stock prices is, number one, the direction. We got to get the direction right. Once we get the direction right, we've got to protect our capital, so we want to use a stop loss, but then at some point we want to harvest or take advantage of those gains. We want to move those gains out of the position and back into cash or back into something else. And again, there's lots of schools of thought on money management and trade management, and utilizing one big position with a really tight stop and just trading that one position and doing that over and over and over again, whether it's Microsoft or whether it's Apple or whether it's whatever the case may be. Okay? There's also the in terms of portfolio management, I prefer to utilize a portfolio method only because I feel like it's the most adaptable for most traders. Most people can do this. It's not that hard, but it is, and it reduces the amount of volatility a lot oftentimes because we use smaller position sizes. Okay, now the position size is going to be the number of shares that you enter into the trade. We talked about that yesterday, and we talked on Tuesday. And we talked about that 2 to 2.5% range. Okay, 2 to 2.5% of allocation. So if I'm trading with a $10,000 account, I'll bring it down. I don't know what everyone's account values are, but let's say that, usually it's 20 to 50,000 or something like that on average. Let's say that it's 10,000, and I'm coming in and I want to take on this approach, and I want to buy a stock, and we go into the position size. How many shares am I going to be buying? Well, based on this 10,000, then I'm going to be buying 2% of 10,000, which is $200. Okay, so I'm only going to be risking $200. So if I'm buying a stock that has a share price of 200, then I'm going to buy one share of that. So this 2% is based on your entire amount that you are utilizing for this method. It doesn't have to be your entire trading account, but if you said, I'm going to allocate, of my 50,000, I'm going to allocate 10,000 to just this strategy, then you're only using that 10,000 of your 50,000, and that's 2% of that smaller fraction. Okay, so break this number down into the actual dollar amount that you are going to be exposing to equities. Now, this you could raise that a little bit higher, because oftentimes we can't ever get to a fully allocated position because of that position size. And I'll show you what I mean by that. We end up holding a lot of cash because we have a stock that maybe runs for 15 days, and then we just get stopped out or we sell it, and then we get a new one. And so we have always this moving portfolio of stocks that we're adding to that are a new position for the day, and then maybe we get stopped out of something that day. So we're adding something, and then maybe we're selling, taking something, some gains off of a run that we've had on a stock. So there's always something happening. And in this case, we're able to look for new trends. As new trends are beginning, old trends are ending, and ideally continue to maintain an optimized portfolio. Now, the lever to create more or less risk or volatility are these numbers. Okay, I could say I'm going to do everything the exact same. I'm going to buy a stock and sell a stock. I'm going to have my initial stop loss and risk capital. Every time it's going to be the same, but this becomes the lever. If I want to take more risk, I change this number. I go up to 3% or I go up to 5%. Okay, let me delete this. Now, what does that mean? We know what that means. Okay, I'm not necessarily using this stock as an example, but if I'm saying, if I have the percentage, and this, I need to add a $10,000 count, this 100,000, if I'm using the number of shares and I'm sticking with that 2%, okay, let's go, that's gonna be about 70, 65, 66, 67, let's go. So right at 2%. So 67 shares, and again, just if I were buying this stock right now, that 2%, and I'm going to have this big of a position, this 2%. Now, the stop, now if I had a stop loss and I said, okay, that stop loss is gonna be at 29, now I've got 0.15 of 1% at risk. Okay, now if I'm going to change that number and I'm going to, if I want to take more risk, I don't have to change anything about my setup, what I'm doing as far as that process. All I have to do is change the number of shares. Okay, and I just increase this number. If I go to 200, okay, now I've got $474 on the line with a $29 stop, but my position size is 6%. Okay, so if I want more risk, I just buy more shares. Okay, and that's essentially that's the lever that you're pulling to say I still want to follow the system, but maybe I want to take a little bit more risk. Well, that is just to increase the position size, and then with that you add additional volatility because you may get a real big winner with that 6%, but you also may get stopped out at 29 and say, okay, I took a bigger position and therefore I've taken on a little bit more risk. But if you have a 6% allocation in one stock instead of a 2% allocation in 3 stocks, okay, essentially then I'm betting a little bit more on this, but more than likely I still would have allocated, that's still going to be a part of the portfolio. I'm still adding into new positions. Okay, so this number right here, at some point, if you want a little bit more risk, that taking 6%, you're going to start to cap out. You're going to have more than enough stocks, more stocks than you can buy. And the smaller the number, the more stocks you can add. So again, theoretically, you're reducing risk because you are adding additional trades instead of one. Okay, at 2%, I add 3 different stocks instead of 6%, and it's 1. Okay, so a little bit of, it's really just kind of how it's going to be allocated towards your overall trading plan. Hopefully that's not confusing, but it's the 2 things that you can that allow you to have control over the process, or at least manage the risk. Okay, there are a lot of things that we can't control, and so we have to make sure that we are managing the things that we can when it comes to the trades. Now, taking profits. So let's say that I've got a stock, and let's talk about what the goal is. Okay, this methodology, the goal is buying a stock that's in an uptrend. Okay, so here we've got the green, and as it's moving in this uptrend, we could buy it along the way at any point. It's going to show up in the new buy scan because it's gone from a hold to a buy here, probably had a high rank. It's gone from a hold to a buy a couple of different times. So in terms of buy locations along the uptrend, that's where we're looking. We're looking here from that hold to buy, or we were looking here, okay, or here if we're continuing to buy. We got into this one again. I can't remember if it was here or here, but now it's never retraced deep enough to stop us out. It's pretty close here. It might have been pretty close here, but in essence, what we want to do is we want to let that thing just go and go and go and go until it stops. Now, the hard part of doing that is the structure from day to day. Okay, that's the hardest part. Is it's easy to look at a chart, or when putting together marketing materials and say, here, this stock went from here to here in 12 months. That the hard part of following that is every single day dealing with the volatility. Yes, it went up and then it went down and then it went up and then it went down and then it went up and it went down and then it went up. It's that process. So knowing from day to day, okay, how I'm still in the uptrend, I'm still holding support at that 236. I'm going to continue to do that. I'm going to place a stop loss here. At some point, it's going to reverse back down. If it goes lower than a location that we're not okay with, okay, we want to start locking in the gains at some point, and that trailing stop allows us to do that. But how high is high? Okay, how high could this thing go from here? That's what we don't want to reduce ourselves. We don't want to limit ourselves from the upside, because that's ultimately what we are trying to capture. Okay, on a lot of these trades, we're looking for, in the time frame here, we're looking for this overall uptrend. A lot of these muscle stocks that are ranked at 100, they've already had big moves and some consolidation, and they just keep stair-stepping higher. Those are the ones that we want to get in on along the way. Okay, here's IREN. We did add this one in right here. It was a little bit later in the trend, but we added to it, I think it was right. It was either this day or this day. So now it's continuing to move higher relatively early, potentially in the trend. But how high could some of these stocks go? That's what we want them to go hundreds of percent before we ever sell anything, because it's very, very tempting. It's very tempting to say, oh yes, we're up 25% or whatever it is in a short amount of time. Let's just cash that in and sell. Now, there's nothing wrong with that if that is your trading plan. Okay? It's always about what the process is and what the plan is. But in my experience, you're never going to get the best of both worlds. You're never going to get high return, low risk. You're never going to get not having a stop loss versus selling at the exact peak. Okay, those are what we can try to do is manage those and say, if I've got a position that is now up a certain percentage or at a certain range in the trend, let's say I bought it at the bullish point of the trend and it becomes extreme. It shoots all the way up to 250. And I know that, yeah, it could go higher in the longer term, but in the shorter term, it's probably going to have one of these, maybe a little pullback along the way. So maybe I want to sell some of these positions into the strength. Okay, now there's arguments both ways of pyramiding into your winners, meaning adding into what's already working, versus selling what is working for you. Those are two different methodologies. I typically don't teach the pyramiding into your winners a lot, but that certainly is, as things are winning, you can add into your winning positions doing this exact same thing if you already own a position and it hasn't been stopped out. For example, let's go back to where did my brain just go there for a minute? Okay, USAP. We could say if we don't get stopped out of this and we get another confirmation bar, we could say I'm going to add more to this position if I don't get stopped out and I get a new confirmation because it's working already. Okay, now my opinion is we want to add into something that's earlier in the trend. But if you've got something and it's working and it's pulling back and it's just continuing to move like clockwork, you could also go into a little bit higher risk entry. I shouldn't say higher risk, but a little bit earlier entry, and that is buying right at the support. Okay, so you're buying right at the support, and maybe you have a little bit deeper stop loss. So instead of getting a confirmation bar and having a stop, you buy at the support and you have a stop loss. It's still going to allow for some volatility, but then you know that if you buy here and it immediately breaks that support, probably need a little bit tighter stop on that. That's also another entry approach, although we're talking about exits, but this is another way to add into positions is to be able to buy into what is already working for your portfolio, but do it the same way. Do it on a pullback, retracement, confirmation bar, everything that we're still focusing on, even in our overall uptrends. We have a stock that moves higher and retraces. We still want to see that process, but we can add into it on one more confirmation bar there as well. Okay, so the selling process in this case with USAP, it was up about 60%, and it was starting to make a little bit larger. Some of the others hadn't caught up, and it was making a little bit larger um, position size. And so here I had sold half the position at about 60% gains. And notice now this is 1.93. So it pulled it back, and it's dropped a little bit since then because we sold it into the strength and rebalanced that. So essentially we're taking those gains. The way I see it is we're taking the gains of the winter and we're moving them back to cash. And that cash is eventually going to get redeployed into a new stock with a new uptrend. Okay. And that new uptrend may not work. And this could have been the one to add into. That's the woulda, coulda, shoulda scenario. There's always going to be that, but we've got to just stick to a process, and that process is essentially taking the gains, selling into strength, and you can do that at any time. You can sell anything into any strength just to help offset some of the risk of a larger position, and put that money back into cash. Keep it in cash if you want. Okay, as market conditions are changing, you can take some of those winners and not redeploy that cash as well if you're keeping a certain cash level. Right now, we're starting to accumulate because we're not getting stopped out of as many things as market conditions are continuing to work. But we are getting some volatility and some retracement in here. A couple of these newer trades have taken off quickly and offsetting a couple that have been kind of dogs and just really not been moving a whole lot. And we got stopped out of a couple today as well, or at least one, I'm sure of. So let me just summarize here as we're looking for exiting. So our entry process, again, you can add into your winners the same process, using the same process. You can sell from your winners using a rebalance. I wouldn't sell into strength ever, most of the time, unless markets are really crazy and the stock has gone, straight up. Sell the entire position into strength versus selling most of the position or half the position and then using a trailing stop on the rest. Okay, that's one of the ways to try and get the best of both worlds, is we're selling some of the shares into the strength, but we're keeping the rest and then we're trailing the stop. Then if it continues to move higher, we've at least got a position that just keeps moving higher and higher. Oftentimes that's referred to as a runner, but on an individual trade, but in this case, it's still kind of a runner. We're selling some into the strength and trailing the rest of the shares. And if they get stopped out, we won't have made as much on that portion of the shares that we kept. But if we don't get stopped out, we're going to make more money on those shares we kept versus the shares that we sold a little bit earlier. Okay, so two different ideas for you to consider as far as adding it into a systematic process. When should I be selling? Okay, it's typically based on the portfolio percentage of that holding, if it's getting too large, or your own personal risk tolerance. If you're feeling like, man, this, markets have been sketchy and I want to just take some of these gains, then by all means do it. Okay, just hang on to some of the shares, set your stop loss up, do it in a structured way so there's not emotion behind it. Those emotional trades are typically the ones that we regret. And that could be selling too soon. Selling too soon, for me, are the biggest regrets, because when you get it right and you watch that thing take off and you're not in it, that is very frustrating. But a stop loss is not frustrating, but selling too soon is. That is, especially this methodology, we need to have some of those longer term real big winners. Market conditions, again, just to summarize, things are looking good right here, upper end of the range, some shorter term breadth issues with buy-sell ratio, but overall watch to see on S&P 500 if we can hold this support right where we're at right now. That'll do it for today's update. Everyone have a fantastic weekend. Bye now.